Okay, so today I'm going to be talking to you about the practical approach to implementation of the lease standard. This is a complex standard. It can be overwhelming, but I'm hoping today we can go through some processes that will help you in your implementation, some practical points that will help you hopefully, so this won't be quite as daunting as a task once you get to that point. So I'm Gary Snyder. I'm an audit manager. I did join SEK in 1996. I have 24 years of experience. I graduated from Shippensburg University, and I work with various nonprofit organizations throughout the year to help them with their not-for-profit goals and experiences, and I can bring a wealth of experience to them to help them with their goals. So an overview of what we're going to cover today, we're going to go through the basic requirements of the ASU 2016-02, which is the lease standard. We're going to go through the difference between finance and operating leases and the requirements for both. Recognition and measurement of lease transactions, we're going to go through some sample entries to see how they're recorded. Disclosure requirements, we're going to go through what is required for the lessees. We're going to go through some practical expedients that are available for implementation, and then implementation effective dates and requirements for implementation. So an overview of the standard, the purpose is to increase transparency and comparability among organizations related to lease transactions. So you can have several different organizations that lease significant amount of equipment, say trucks or airplanes, or significant dollars involved. That could have significant liabilities related to those lease obligations that may not be recognized other than a footnote, particularly for operating leases. The point of the standard is to get those on a balance sheet as liability so that you can compare one company that has leases to another company that has leases, and you have more comparability between the entities. So this really affects the lessees more than the lessor. The accounting disclosure is significantly changed for the lessees who lease the equipment. With the lessor, there's minor changes, but really not significant changes related to the lessors. This does only apply to property, plant, and equipment. It does not apply to intangible assets, natural gas and oil, timber, inventory, and assets under construction. So finance versus operating leases. Finance leases are equivalent to our current capital leases under current GAAP. And there's criteria listed here, which is very similar to what we use for the current capital lease criteria, with some slight variations. So I'll go down through these and you'll notice a couple differences between what we have currently. So under financing leases, it is considered a finance lease if it meets any of the following criteria. So the lease transfers ownership of the underlying asset by the end of the lease term. The lease grants the lessee the option to purchase the underlying asset that the lessee is reasonably certain to exercise. The lease term is for the major part of the remaining economic life of the underlying asset. You'll notice major part there is highlighted. In current GAAP, under the capital lease requirements, that is a specific percentage. There are no specific percentages or bright lines in this. It is major part, which is much more subjective. The next one then is present value of the lease payments and residual value guaranteed by the lessee equals or exceeds substantially all, and again, you'll see that's highlighted, the fair value of the underlying asset. Again, substantially all used to be a percentage. The next one is the underlying asset is of such specialized nature that it is expected to have no alternative use to the lessor at the end of the lease term. So if it meets any of those criteria, it's going to be considered a financing lease. If it does not meet any of the criteria, then it is considered an operating lease. And the operating leases are very similar to what we have today in the current GAAP. So what is the difference between finance and operating leases? The requirements for both when you initially record the transaction is exactly the same. So what is going to happen with the new standard is you're going to recognize a right of use asset, an ROU, and a lease payment liability, an LPL, measured at the present value of the lease payments on the balance sheet. Again, that's going to be the same whether it's a finance or operating lease. The difference is in subsequent measurement and subsequent years, recording them in the income statement and the cash flow statement. So when finance leases, you're going to recognize the interest on the lease liability, and then you're going to amortize the ROU on the income statement. You're going to recognize both those in the income statement. For the statement of cash flows, your principal payments are going to be classified as financing, while your interest payments are going to be considered operating activities. On the operating lease side, then, you're going to recognize a single lease cost allocated on a straight line basis in the income statement. And then any payments are classified as operating in the statement of cash flows, which is similar to what we have now under current GAAP. So some general considerations at commencement date. When you are initially entering into a lease, at that commencement date, you need to assess what classification this lease is going to fall under. Is it going to be a finance lease? Is it going to be an operating lease? And that should not be reassessed unless the loan is modified or unless there are some kind of options to extend the lease, purchase a lease, something like that. Those options wouldn't have to play into that then. The lease would have to be reassessed at that point in time. But if you don't have those, that classification should not be reassessed at all during the term of the lease. One key piece of the standard is options. If you have options in a lease, you must be reasonably certain that you're going to exercise those. And reasonably certain is a high degree of confidence that a future event is going to take place. So for example, if you have a 5-year lease with 2 5-year options, you need to evaluate at the commencement date, what is the reasonable certainty that I'm going to exercise those options. If I feel I'm only going to be in there 5 years, that's what I should base my calculations on. If I feel I'm going to exercise only one of those options, it should be 10 years. That's what you should base it on. But you have to be reasonably certain at that point in time when you commence the lease of how you're going to factor in those options to your calculations. For leases less than 12 months, you can make an accounting policy election by class of underlying assets to not recognize those assets and liabilities on the balance sheet. However, you need to, again, factor in the options. So if you have several options, if you have a lease that's less than 1 year, but you have all these options that will ultimately take it out over several years, it's really going to be hard to make a case that is a short-term lease that would not need to get on the balance sheet then. The right of use asset is an intangible asset that the lessee has purchased the rights to. It is typically classified as long-term on the balance sheet and it is amortized over time. The lease payment liability is the most critical calculation in the recognition of the lease payments. So at commencement date, you're going to have to factor in any forms of payment into that calculation. For example, there are fixed lease payments less any lease incentives, variable lease payments that depend on an index, exercise price of options to purchase those assets or to exercise options within them, penalties for terminating the leases, and any amounts probable to be payable. So if you have any costs that you know about at commencement, you have to factor those into that lease payment liability so you have an accurate measurement of that liability going forward. This is based on a discounted present value. It is based on a discount rate. That rate should be based on the rate implicit in the lease agreement. The lessee is probably not going to know that. The lessor will know it because of the return, but the lessee may not know that. If you do not know that, you can use your borrowing rate, your incremental borrowing rate as your rate. That's fine. And private companies may make an accounting election to use the risk-free rate or the Fed funds rate for their rate. They can make that election. One thing you have to be aware of there, though, is if you use a risk-free rate, it's going to be lower than your effective borrowing rate, so you can expect your ROU and LPL to be higher than when you record those transactions. So it's just something to keep in mind on that. So here's an example to show the recognition of these leases for an operating and a finance lease transaction. So an operating lease, NFPA leases a copier for a 3-year term. Lease payments require payments of $10,000, $100 for 36 months. The present value of the lease payments is calculated to be $3,000. The lease qualifies as operating lease. So the entry at inception, you're going to debit right of use asset for $3,000 to get the asset on the books. And then you're going to credit lease payment liability for $3,000 also. Then in the subsequent year, you're going to have 1 year of payments, and these are annual entries just to make it for ease of presentation here. You're going to have annual and payments of 12 payments of $1,000. Sorry, 12 payments of $100 would be $1,200. And then the present value of the lease payments at the end of year 1 is calculated to be $2,000. So the entry for the first year is you're going to debit lease expense for $1,200 to recognize the lease expense. You're going to credit cash for $1,200 to recognize the payments that are made. Then the liability is going to get reduced by $1,000 to get it down to the present value calculated amount of $2,000 at the end of the year. And the right of use asset is also going to get reduced by $1,000. So you're going to credit that also. So pretty simple transactions, recording of those. Then the next transaction is a finance lease. So NFPB leases office space for a 5-year term. Lease payments require payments of $1,000 a month for 60 months. The present value of the lease payments is calculated to be $55,000. The lease qualifies as a finance lease. So again, at inception, these are going to be exactly the same between operating and finance leases. So you're going to debit the right of use asset for $55,000, and you're going to credit the lease payment liability for $55,000. In the subsequent year, then, you're going to have 1 year of payments. 12 payments at $1,000 is $12,000. And the present value of the lease payments at the end of year 1 calculates to be $45,000. So the entries for these, you can see, are a little bit different. So the first entry is to amortize off the right of use asset. You're going to debit amortization expense for $11,000 and credit right of use asset for $11,000. Now the $11,000 is the $55,000, the original amount, divided by the 5-year lease term to get the $11,000 a year, so you can write that right of use asset off. On the liability side, then, the lease payment liability is going to get reduced by $10,000. You're going to debit that for $10,000 to get it down to the calculated $45,000 amount. You're going to debit interest expense for $2,000, and you're going to credit cash for $12,000, which represents the amount of the payments of leases you have made during the year. So disclosure requirements under the standard are significantly more involved. There's much more detail to be presented than is under current GAAP. So we're going to go through some examples here and show you what is required. And hopefully by these examples, you can get a better feel for what is going to be required for disclosure purposes. So qualitatively, you're required to disclose a general description of the leases, whether there's any variable payments in those, options to terminate or extend the lease, and how they factor into your right of use asset and the liability calculations, any restrictions imposed by these leases. And if you have subleases, you also need to include the same information for those subleases. If you have any information about leases that have not yet commenced but create significant obligations, you need to disclose those. And you also need to disclose the significant assumptions and judgments made in applying the requirements, including like the discount rate. How did you come up with the discount rate? What's it based on? And disclose that information also. Quantitative disclosures, you can see there's a laundry list of quantitative disclosures that are required. The key piece here is that this information needs to be disclosed separately for financing and operating leases. So you could have finance leases, you could have operating leases, but you need to disclose those separately for each type of lease you have. So here's some examples, and I don't want you to pay a lot of attention to the numbers. These are just numbers I threw in there. But I want you to at least get a feel for here are the requirements under the standard for the lease components that are required to be disclosed. So the components of lease expense is the first requirement. So you can see there the lease cost is the finance lease cost of amortization of the right of use asset, and the interest on lease liabilities comes down to your total finance lease cost. Then there's also operating lease cost, short-term lease cost, variable lease cost, and then you're going to subtract off your sublease income to come down to a total net lease cost amount that is disclosed. The next one is supplemental cash flow information that's required to be disclosed. Again, you're going to have operating cash flows from financing leases, operating cash flows from operating leases, and financing cash flows from financing leases. So those are the cash flow pieces you need to show. You're also going to have to disclose the right of use assets you obtained in exchange for those new finance leases and for new operating leases. And again, you'll see they are broken out separately between finance and operating leases. Supplemental balance sheet information is another disclosure. For operating leases, you need to disclose the right of use assets and the operating lease liabilities. For finance leases, you have to disclose the property equipment, accumulated depreciation, and property equipment net of those assets that are subject to those finance leases. And again, you need to disclose in the right of use assets and the lease liabilities for those finance leases also. The weighted average remaining lease term and the weighted average discount rate, again, broken out between finance and operating leases, are also required disclosures. The next one is maturity of lease liabilities. This is similar to what we have now, only you'll see it's broken out between finance and operating leases. You need to show the 5-year payments coming up, and then thereafter come down to the total lease payments. You subtract off your imputed interest, and then you come up to the amount which should agree to your balance sheet. So those are required disclosures. You can see there was a significant amount of disclosures there, but there are some practical expedients within this standard that does help in the easing the implementation of the standard. So I want to go through these, and hopefully this will kind of help ease the transition when you actually do have to start putting these leases on the balance sheet. So the first three have to be elected as a package and applied consistently. You cannot just pick and choose these. These three have to be implemented at the same time consistently. So what it allows is you do not need to assess whether the expired or existing contracts are or contain leases. You do not need to assess the lease classification for any expired or existing leases. So for example, if you already have an operating lease, when you transition, you can just say that's going to be an operating lease, even if it isn't. If it's a capital lease now, it's going to be a finance lease when you transition. So it makes that a whole lot easier. You don't have to sit there and reclassify these when you're implementing the standard. Then you also do not need to reassess initial direct costs of any existing leases. And you can tell by these practical expedients that the standard setters are just trying to get these on the balance sheet and move forward based on what the information you have now. They don't want you to spend a lot of time going back and reevaluating leases and spend a lot of time, because they got a lot of pushback. You can imagine if you have thousands and thousands of leases, it's going to take a significant amount of time to go back and reevaluate these leases. So this was an easy mechanism to help implement these and get them on the balance sheet and move forward with what existing information you have. The other expedient then is it does allow you hindsight in determining the lease term. So you can consider options to terminate and purchase the leases, any other options you have within those leases. You can sit back, you can say, okay, in hindsight, we probably should have done this option differently. We should have handled that differently. You can do that when you're implementing the standard and use hindsight to change that and it goes into your factoring. This can be elected separately from the three above. So this is independent of those three above. You can or you don't have to elect this one with the other ones. And again, as you can tell, these were designed to reduce the effort to go back and reevaluate leases that are already on the books. It's just a matter of taking them, getting them on the books and moving forward with the standard. So the implementation dates, this was originally effective for years beginning after December 15th, 2020 for non-public companies. However, due to the pandemic, in June 2020, FASB issued a new ASU that does delay this for 1 year. So now this is effective for calendar year 2022 or fiscal year 2023. So you do have some more time to implement this. The implementation approach that does require a modified retrospective approach, which requires recognition and measurement of leases at the beginning of the earliest period presented. So what that would require would be you would have to, if you implement this on January 1st, 2022, you would need to put your balance sheet information on for the leases, the assets and liabilities related to those leases. Then you would have to go back and recast 2021 to also include those assets and liabilities to be comparative. However, the ASU in 2018 was issued that doesn't allow another option. This allows you to apply the standard at the adoption date and recognize a cumulative effect adjustment to the beginning balance of retained earnings. So what does all of that mean? That means on January 1st, 2022, you can record your asset and liability for the leases. If you have any cumulative effect change adjustment, you can run that through retained earnings at that point in time. 2022, you would have all the assets and liabilities on the balance sheet. You would have all the disclosures that are required. But then for the comparative information for 2021, you would not need to go back and recast that. You can just follow current GAAP on those disclosures and information. So you're not going to have, you can have comparative financial information, but the disclosures are not going to be comparative, and that's okay under this option. So again, it does ease the transition to this standard. It makes it a little bit easier for everybody to transition. So in essence, you can see with these practical expedients, the lessees are in essence continue to account for the leases the same way they are under current GAAP until they're modified. The only difference is you're now going to have an asset and liability, and going forward, once you implement the standard, you're going to have to, you're going to have to include the disclosures, you're going to have to include all the information, but then you don't have to go back and reevaluate everything. You can just follow current GAAP until those leases are modified in some manner. So I hope this has helped you kind of get a better practical view of these and help you with your implementation of the standard when you do get there.